Good afternoon. This is Mary Tressel, and I'd like to welcome you to Armanino's webinar today, Your Nonprofit Audit, How to Plan and Prepare. First, I'd like to explain to you how to use your webinar pane. You will see it at the top right-hand corner of your screen. If you'd like to expand that webinar pane, simply click on the orange arrow, and there will be a space where you can type in and enter a question for one of our presenters. We will answer the questions at the end of the webinar as time permits. If you want to minimize that webinar pane, just click on that orange arrow again, and it will shrink up over to the right corner of your screen. Make sure that you have selected the correct audio settings. If you're using your telephone, click on that telephone button. If you're using your computer's microphone and speakers, please select that button. This helps you to eliminate the echo sound that may occur with the webinar. And now I'd like to introduce our presenters. First is Monica Pelz, a partner here in our audit department with Armanino. She's been assisting nonprofit organizations with their accounting and compliance needs for more than 18 years. She's a member of the AICPA and the California CPA, the Cal CPA. Prior to joining Armanino, Monica was with Ernst & Young. Grant Lim is also a partner in our audit department, and he joined Armanino in 2003. He's got more than 12 years of experience auditing and consulting companies and organizations in a broad range of industries. He graduated from UC Berkeley, the Haas School of Business, and he began his career with Armanino shortly thereafter. He works extensively with nonprofits and specializes in A133 auditing. Finally, we have Dean Quiambo, a partner in business development for Armanino. After spending 12 years as an auditor in Armanino's audit department, Dean transitioned to his new role, Chief Relationship Builder for our firm. He helps numerous private schools, social service, performing and fine arts, and faith-based organizations address their tax, audit, and outsourced accounting needs. And with that, I'm going to hand it over to Monica.
Thank you, Mary. So we're going to talk about a couple things today. It's that time of the year, time to start preparing for the audit, thinking about closing out your year. You might even have your client assistance list from your auditors already. And what we want to do is we really want to help you have a successful audit. And it might sound odd putting those two words together, a successful audit. And so you're asking maybe what does that mean to have a successful audit? And what does it mean to you? It might be a no material weakness in internal control. Maybe it's fewer audit adjustments. Maybe it just means getting the auditors out of your conference room earlier this year than last year. Whatever it means to you, that's what we want to help you with today. Just giving you some helpful ideas and some information about planning and preparing. Dean and I are going to talk about some general challenges that we see with nonprofits in the audit process. And Grant and Dean are going to dive deep into single audits and A133 compliance more specifically. So a successful audit, and you might ask, why is that important? And it's all those reasons I gave before. Maybe it's the no material weakness, fewer audit adjustments, fewer open items when the auditors leave. If you have all of those items, it means your financials are probably going to be more accurate. And there are some really key steps. So I find that there are 4 key steps in being able to achieve more success in your audit. The first one is planning.
And Monica, I have to ask, that's a big, wide word. What do you mean specifically by plan?
It is. I say have a planning meeting, sit down with your team internally and with the auditors. You want to define a timeline and have some real specific goals. I know when I'm working with clients and I'm developing those timelines, I always start with my client's desired issuance date. Or maybe the deadline is the 9/90 that everyone's focused on. I always start with that date and then work backwards. And I'm able to set dates for specific check-ins, items that we want to have done on specific dates. And that really helps develop the plan that everyone can get committed to and behind if you have those planning meetings. The second item here, close your books. That might seem obvious, but what I mean here is don't let the audit process trigger your own close process. Make sure you're closing your books monthly basis. Maybe it's just a quarterly basis where you're truing up some accruals or looking at your net assets, but you want to do that independent of the audit. This third bullet point here, check in with your team during the audit and with the auditors. I always say no news is not necessarily good news when it comes to the audit process, so definitely keep in touch with everyone and finally communicate. And communicate here, not just during the audit process with these check-ins, but all year long. You want to make sure that your auditors are up to speed on what's been going on during the year. If you're having, say, some troubles reconciling an account or maybe an unusual transaction during the year, let them know, talk to them about it. That will eliminate surprises during that actual audit. Here are some common challenges. Grant, Dean, and I all work with nonprofits, and we frequently see these as some challenges that nonprofits can face. The first one is just limited resources.
And Monica, when we talk about limited resources, we could be thinking of two things. Number one is segregation of duties, and the second thing could be turnover within certain job positions.
Absolutely. Those are all challenges that a nonprofit might face, and all result the same way. There are just limited resources available. As you said, that could be a risk for segregation of duties issues, which could lead to some internal control comments during the audit. It could lead to letters or communications. Definitely a challenge.
Right.
Go ahead. To say a little bit more about segregation of duties, because it is a common issue that I see many nonprofits face, especially with limited resources. And the basic concept of segregation of duties is that no employee should be in a position to both commit and conceal fraud and errors, but having that complete segregation of duties is challenging for many nonprofits because of their limited resources. So in instances where optimal segregation of duties isn't practical, we recommend having mitigating controls in place. Consider using your board or your volunteers, have them integrated into your office procedures, give them assigned responsibilities, make sure that they're trained on the organization's practices, and that will help. Just getting more people in the process will help you achieve that optimal level of segregation of duties.
Right, and with regards to resources, if your nonprofit is one that has experienced turnover in some key positions, I would encourage you to reach out and make sure that you still are on the path to be ready for your audit. So reach out to organizations like ours. We can help you with that.
Yeah, there are ways to outsource different functions in order to avoid these sort of conflicts that Grant and Dean just talked about. Second item here, lack of planning. Everything I talked about before, that planning process can really lead to some challenges during the process. Finally, or actually next, the separation or thinking of the 990 process as a separate project from the audit engagement. I really encourage you to look at these as one project together. There is some information that your 990 preparer can use from the audit, but there's some information that's just different. So make sure you're including the 990 preparer in the meetings and in those status updates that you're talking about during the process with the auditors and with your internal team. So there's some common mistakes that we find with our nonprofits just on a technical accounting side.
Go ahead.
Challenge number one is just determining whether a promise to give is restricted or unrestricted.
Yeah, and that, especially right now, the economy is improving. It feels like how every nonprofit is out there raising funds right now. So I feel like this could be a key issue for everyone who's tuning into our webinar. How are your clients identifying restricted versus unrestricted gifts, Monica?
The key is always having really clear documentation, clear communications. Make sure you're getting the details of the donor intent, because an unrestricted gift is going to be that the promise or the donations made are available for any purpose. And usually unrestricted gifts go towards operating expenses. And this differs from a restricted gift where a donor puts a restriction on the use of their donation for a particular purpose or project. So it always goes back to donor intent. What's their stipulation with regard to how their donation is going to be used? And keep in mind here, a restriction on a gift is going to affect the classification in your financial statements, whether it's unrestricted, restricted, the type of restriction, its classification. And this is different from a condition, where a condition actually affects the recognition, the revenue recognition related to that gift. So conditions versus restrictions, this can be a really challenging aspect of donations to figure out. And just keep in mind with conditional gifts, if the receipt is dependent upon an uncertain future event, that means that it's conditional versus restricted for a particular purpose. And if you have a conditional gift, then it is not revenue until that uncertain future event occurs. And there's one exception, as with any good accounting rule, there's always an exception. If the possibility that the condition will not be met, or if the possibility that the condition will not be met is remote, then the conditional promise to give is considered unconditional. And if it's unconditional, then it can be recognized as revenue.
And Grant, you had a pretty good example of a remote possibility.
Yeah, probably the most common example of that is a stipulation where an annual report has to be submitted or some sort of progress report has to be submitted before the next round of financing will be distributed. So the likelihood of you not submitting that annual report is considered remote. So we would not, as Monica mentioned, in that circumstance, consider that to be a condition for not recognizing the contribution.
Those are good examples. Some other examples that we might see of a conditional gift would be a matching pledge. So there might be a stipulation from the donor that for every dollar the nonprofit organization raises, the donor will match that gift. Versus a restriction, which could be restricted for a particular purpose, like a new building.
Yeah, but out of all the issues that nonprofits face, this is probably one of the top 3 or 5 issues is distinguishing between ambiguous conditions. And our recommendation there is just talk to your donor, review the facts and circumstances, clarify with your donor what the intent of their contribution is, and if after those discussions it's still hard to distinguish whether or not a condition exists, the guidance recommends that you take a conservative approach and treat it as a condition until it's been met.
Yes, absolutely.
That's good info, guys.
And it may be possible for that conditional revenue to be recognized in stages if the conditions are met in stages. So that example of a dollar for dollar matching gift, as your organization raises dollars, then you would recognize the matching gift as well.
Great.
I would say keep in mind with conditional pledges, do not record these as deferred revenue. So sometimes I'll see a contribution receivable and also deferred revenue on the books for a conditional pledge. You don't do that. What you would do is you could record a refundable advance only if you receive the cash. So this last bullet point here, if there's an actual transfer of assets, so if your organization receives cash and you have a conditional promise, then you would record a refundable advance as a liability, and you would release that liability to revenue as the conditions are met. But otherwise, without receipt of the assets, transfer of assets, you would not have any deferred revenue related to the conditional pledge.
Monica, I'm so glad you brought that up. So many times when we go out and what we see that the miscellaneous credit recorded to other liability or deferred revenue, or the miscellaneous debit somewhere on the balance sheet, and you say, oh, well, what is this number? And they say, well, there was this transaction and I didn't really know how to record it. Well, that really goes back to Monica's slide a little earlier. You guys should be communicating, reaching out to your auditors, talking to your advisors now, saying, how should we record these transactions?
Absolutely. I have my clients all the time, if they have an unusual pledge document or something comes across their desk and they're just not sure, because the language can be very ambiguous. Something like, my intention is to set up a scholarship endowment. That while that is great for development, accounting says, what am I supposed to do with that? Is that a promise? Is it restricted? How am I supposed to account for this on a GAAP basis? So always get your auditors involved, ask questions. They can definitely help.
One bullet point on there I wanted to speak to real quick is the bullet point relating to government grants. So I do come across that issue with many of my clients that receive government grants, and many government grants are funded on a cost reimbursement basis. So what that means is organizations will incur qualifying expenses, submit the reimbursement request, and receive funding for those expenses. So the way you recognize the revenue under those cost reimbursement type contracts is that the revenue is essentially earned when the qualifying expense is incurred. And the common error I see and the common adjustment that we propose during our audit is that organizations not recording the related revenue and AR near year end. So you may have incurred qualifying expenses in June. You submit those expenses, but you're not paid for it until July. So in those instances, you want to make sure you book the corresponding AR and the revenue, so you're matching the revenue with the expenses as you incur them. And then while we're on this topic of government grants, another common area that I come across is when organizations receive government grants and the use of those funds are limited to the terms and conditions of the grant award. It may seem like a restricted activity because you can only do with the funds what's stipulated in the award. So organizations at times may want to record that as a temporarily restricted activity. The reminder here is that it's incorrect to record that as a temporarily restricted activity. Temporarily restricted net assets by their nature can only be imposed by donor. They're donor imposed restrictions, and the key word there is donor. Government grants and contracts are by their nature exchange transactions, and exchange transactions are always recorded as unrestricted net assets. Many times you receive a government grant, just because there's restrictions on what you can do with the money, may make it seem like it's a temporary restricted activity. Keep in mind that that's an exchange transaction, and that by their nature is an unrestricted activity.
Awesome, thanks, Grant. We're going to talk a little bit more about exchange transactions in a couple slides as well. One thing I want to bring up about promises also is most commonly promises to give are recorded when there's a signed pledge card, some sort of award letter, a written document. But the standard actually says that a promise can be written or oral, but there has to be verifiable documentary evidence that exists before the pledge can be recognized. So make sure if you have a verbal pledge that you're talking with your auditors about the recognition and what they're going to want to see in order to validate the recognition as of the year end. Restrictions can also be explicit. As I mentioned, it's best if you have if your gift agreements are very clear and very specific. So a very explicit restriction on the use of the funds made by the donor. However, restrictions can also be implied. And one example of that is if there's a big fundraising event and all of the marketing and propaganda around the event is to support a new building construction, and donors are writing checks to contribute, but there's not really any agreement that says the funds are restricted for that building. I would say that there's an implied restriction there because of the circumstances in in the manner that the funds were donated. Temporarily restricted assets. Now these are restricted for a time or purpose and then released from restriction as that time or the purpose is satisfied. An example might be contributions related to scholarships, restricted to use for scholarships, or as I mentioned, the new building. There could also be a permanent restriction on donations, and that's when a donor stipulates that the corpus of their gift must be invested in perpetuity, and that means forever and ever. So that's the corpus of the gift. However, the income generated from that investment might be also permanently restricted. It might be temporarily restricted, or it could be unrestricted. And again, this all goes back to the donor's intent.
Another item, Monica, that does imply about the implied time restrictions that we do see is we see it at a lot of our schools. They take annual fund gifts, but then those payments are made over, say if it's a high school, over 4 years. Well, that essentially, if that gift, that one-time gift is going to be paid over 4 years, then they've just had an implied time restriction, correct?
That's right. That's right. Payments that are due in future periods are temp restricted for time.
Great.
There's also the issue of a contribution of a long-lived asset. So the question, is this permanently restricted or temporarily restricted? I would say that if there's no stipulation about how long the asset must be used, this would be recorded as a temporarily restricted asset with an implied time restriction. And that time restriction is going to expire over the useful life of the donated asset, a building, for example.
Right. And I would say, Monica, that I'm really glad you brought that up, because sometimes you have donors who want to donate a building and call it an endowment. Well, we know that endowment from a donor, technically, the applied restriction there is permanent, right? And it's hard to give. How do you record a permanent endowment when you have a temporary asset?
Right. That's
So,
a good point.
Definitely something to look into there if you have that situation going on. We hope that a lot of our nonprofits have that situation.
Yeah, absolutely. It's always nice when you get a building donated to you. And then completeness. How are you going to make sure that your contributions are complete? And we bring this up because there can be this gap between development and accounting. So it's almost as if the two departments speak a different language sometimes. And this disconnect really can be bridged by having a reconciliation process in place. And that will allow, on a monthly basis, quarterly basis, I would say don't wait until year end, but it allows for a way to reconcile between what development is accounting for as the contributions that have come in and what accounting has actually booked on the books. Because what accounting wants to hear is the cash is in the door. It's an irrevocable promise. It's unconditional. There's no restriction. Development, however, can get really excited when donors make promises. And so getting those two departments on the same page is really important. And we just have one example of a reconciliation here. That's an excellent process to go through.
And real quick, I would say that right now, lots of organizations, we know, nonprofits are raising funds. I think that's really a good idea if you, as the business manager or the finance director, sit down with your executive director and your development director and have a meeting and make sure that everyone knows about all the gifts that need to be recorded, number one. And then number two, Monica, I think that it might be a good idea to make sure that if they have the allowance discussion as well.
Absolutely. And allowance discussion, is the donor going to make good on these pledges? I mean, has something happened? Development's usually the first to know. Accounting is usually the last to know. Development is going to have a lot of good information about changes in the donor situation, and it's really important to get those communication lines flowing.
Yeah, because I mean that's another common, I would say, would you guys say that that's a common management letter comment is if a pledge goes unrecorded that should have been recorded, so completeness is a big deal.
Absolutely.
We see that a lot with organizations that receive bequests or charitable remainder trusts. It may not seem to the development department that's a traditional form of contribution, so they may not communicate that to the finance department. We discovered as we do our inquiries of the development department as a common one that I've seen throughout the years of my clients not properly recording.
That's a great point. And the accounting for those charitable remainder trusts is complicated. So that's definitely something you'll want to talk with your auditors about the minute you hear of it. There are some other common items that we run into. I'm not going to spend a lot of time on these. We just want you to make sure that you're thinking about them. If you have follow-up questions or a specific circumstance, contact any one of us. We're happy to answer your questions. The first item here, functional expenses. The functional expense allocation can be really tricky. And what is important here is that you're utilizing a consistent and reasonable allocation, but also one that's periodically reviewed and challenged. You want to make sure that you're utilizing best practices here. And our recommendations on best practices include using square footage, time, employee numbers for those allocations. Some common mistakes that we find is allocating just 100% to program. Sometimes we'll see just fixed percentages used to allocate expenses. And while percentages are good as just a sanity check on whether your allocations seem reasonable, it's really not a systematic, rational way to go about the allocation. So if you're thinking that maybe your methodology could use a little tweaking, definitely take a look at it.
I would also say that also potentially look at, is your executive director all of their time going to maybe G&A as well? Because we all know that the leaders of our nonprofit organizations spend a lot of time fundraising. Mm-hmm. So you might want to look at that as well. Yeah,
the smaller organizations typically roles that are more administrative, they're doing a lot of things. Maybe they're for a school, they might be in the playground. There are expenses that may be allocated beyond just administration. So it's always, as I mentioned, important to really challenge the allocations that you're using. The second item here that Grant brought up earlier, exchange transactions versus contributions. Contribution, unconditional transfer of assets. Just keep that in mind, okay? It's an unconditional transfer of assets. And we did talk about conditional pledges, but remember when the condition is, when that uncertain event occurs, then it's considered unconditional. Versus an exchange transaction, which is really more of a reciprocal transfer where each party receives and sacrifices something of approximately equal value. So that's the key differentiator there, reciprocal transfer versus unconditional transfer.
That's probably one of the areas I'm seeing come up a lot, Monica, with my clients, is distinguishing between what's an exchange transaction and what's a contribution. So Monica was absolutely right in her explanation of those two key differences. And our recommendation, again, is if you have a contract you're not sure about, reach out to us. We would much rather talk about the transaction early on during the year and get the accounting right rather than finding out about it at the end of the year and having to propose any necessary adjustments. But this, again, is one of those areas that's coming up more and more, and it's getting a lot more gray to distinguish between what's an exchange transaction and what's a contribution.
Absolutely. Then volunteer services. This is always a question that comes up. Do you record the volunteer services as in-kind revenue or not? And with this, keep in mind to record it on your financial statements, it's going to require a specialized skill. There are some other criteria that need to be met as well, but just keep that specialized skill in mind. I think that's one of the primary qualifications of recognition. This last bullet point, off balance sheet discussions, We bring this up because there are some instances where a nonprofit organization might have a completely separate fund that's not included in the financial
Or
statements.
foundation, maybe.
Or a foundation.
Mm-hmm.
And there may be some consolidation that needs to happen. So if you have transactions or another entity that's sitting off to the side and it's not being included in your books, talk to your auditors about it. There may be a consolidation there.
Yeah, and I'd say, a couple key words that auditors love to hear when you hear about a foundation is sole beneficiary or sole purpose, or all the proceeds from this foundation are going to go to one entity and one entity only. Those are some key words, some buzzwords that make that pretty interesting.
Absolutely. So your ears should perk up if you hear that during your day-to-day, and then pick up the phone and make a call. All right, so I'm going to turn it over to Grant and Dean now to talk about preparing for single audit.
And it sounds like, talking with Grant, there's been some significant changes to the guidance surrounding the administration of federal awards. So Grant, what are some of the key changes that organizations receiving federal funds need to be aware of as they plan their upcoming audit?
It's a great question, Dean, and you're absolutely right. The OMB, as the Office of Management and Budget, they've issued massive reforms surrounding the administration of federal awards. So all organizations that receive funding from the federal government or that are in the process of applying for federal funds need to be aware of what these changes are and how it impacts their organization, number one. And number two, really think about whether or not your current set of policies and procedures are up to speed in accordance with these new sets of guidance, especially now as you start preparing for your single audits. Many of these changes may impact your upcoming single audit. So for purposes of this discussion, we'll focus on the key changes, number one, and number two, really discuss what you should be thinking about now from an implementation standpoint so that you can be in compliance with the single audit. But before we get into all the changes, I think it's important to understand the objectives of the reform, because that's what's really driving many of these changes. One of the objectives is to reduce the administrative burden surrounding the administration of federal funds. There were many in the grants community that were voicing their concerns that they were spending an inordinate amount of time dealing with burdensome compliance requirements and not really able to focus their efforts where it mattered most. That was using the money for their intended purpose. So part of the objectives of this reform is reduce some of that administrative burden, streamline the process, and just carry out the entire administration with a more risk-based and smarter approach. The other objective is to ensure that federal agencies are bearing their fair share of the costs. Federal agencies are willing to pay their fair share of the costs, but then it also puts more of the onus and the responsibility on organizations to have policies, procedures, and controls in place to accurately account for what those costs are. So the government's willing to pay their fair share, but they want to know that what's being reported to them is an accurate representation of what it costs to run the programs. So keep that in mind as we go through this discussion, because those two objectives is kind of what's really driving many of these changes. As I mentioned earlier, the Uniform Grant Guidance covers many areas of change. We can put on several webinars worth of going through these changes and how it impacts your organization. But for purposes of this discussion, we'll really focus on some of the key areas, which are how the new rules impact time and effort reporting and subrecipient monitoring. And we'll take a look at internal controls under the new guidance as well. So effective dates. This is a question that's come up quite a bit, and I think there's still some confusion out there. So there's three main areas of reform. There's administrative requirements, cost principles, and single audits. So the changes with respect to administrative requirements and cost principles will take effect for all new federal awards that are entered into after December 26, 2014. And for any incremental funding to existing awards made after that date, if there's a change in the terms and conditions. So if your organizations received any new federal awards after December 26, 2014, then you would be subject to the new admin requirements and cost principle rules. If you have an existing award, but you received additional funding, and as a result of that additional funding, there's a change in the terms and conditions, you would also be subject to the new admin requirements and cost principles. And with respect to the single audits, this is the third area of change. This will become effective for fiscal years beginning on or after January 1st, 2015. So if you are a calendar year end, December 31st, the first fiscal year that the new single audit rules will impact you would be December 31st, 2015. If you are June 30th year end, your first fiscal year impacted by the new single audit rules would be June 30th, 2016. So for this upcoming round of audits, organizations with respect to the single audits will be subject to still the old single audit rules.
So to clarify, Grant, will organizations with a 6/30 year end have their single audit coming up be impacted by these new changes?
I guess it really depends, Dean, and that's a common question that we get, because it really depends on whether or not you've received any new awards after December 26, or if you have any incremental funding since that date. So some organizations, if they haven't had any new awards or any incremental funding, won't be impacted at all by the new admin requirements or cost principles. Or some organizations may be in a weird transition phase situation where they have some new awards, but they also have old awards. So they almost have to be in accordance with these two new sets of both the old guidance and the new guidance. My general recommendation is to just starting now, it's very important to just understand what the new changes are, because eventually they're going to impact all organizations that receive federal funds. Okay, so moving to the next slide, internal controls. This is a big part of the new guidance. The core principles surrounding internal controls haven't changed. But the change here is now the guidance places a much greater emphasis on having sound internal controls. So what does that mean? That means as an organization, you need to have controls in place that provide reasonable assurance that your organization is managing the federal awards in accordance with the federal statutes, the regulations, and the terms and conditions of the federal award. So what that really means to me is that as a grant recipient, you need to go through all of your awards, determine which compliance requirements apply to your federal awards, and really sit down and think about whether or not you have internal controls in place to ensure that those compliance requirements are being adhered to. This is a common issue and error that I see with many of the organizations I work with, is that they may have really sound internal controls surrounding the general processes. For instance, their general cash disbursements process, their general cash receipts process, their general payroll process. All those controls can be dialed, but when you look at what controls they have surrounding the compliance attributes, those are sometimes lacking. By that I mean, what controls do you have in place to ensure that only allowable costs are being charged through to the federal award? Or what controls do you have in place to ensure that payroll is being properly allocated to each of the federal awards? And these are the controls that they're really looking at. And as part of our single audit, we look at both. We look at both the compliance attribute and the internal control over compliance attribute. So key part of the guidance is they want organizations to operate with a smarter risk-based approach, and how you get there is having sound internal controls overseeing your grants administration process.
Well, Grant, do you have any recommendations or suggestions on how organizations can implement best practices with regards to internal controls?
Sure. I've had many clients the past couple months reach out to our team with questions on how they can implement these best practices. We've gone out and met with organizations to go over these changes and help them review their controls. We're more than happy to do that with anyone that may need this assistance. But first off, my recommendation is to read the section on internal controls. It's not a very long section, but it includes a lot of important information. So read through it, make sure you understand it, and then go through your control processes. As I mentioned earlier, go through the compliance requirements that may apply and make sure you have controls and document those controls. The guidance doesn't state that it has to be documented. It's not a must-do requirement, but we strongly encourage you to establish it and document those internal controls. And then Green Book and COSO, use those two frameworks as a standard for setting up the framework of your internal controls. So the actual guidance states that your internal controls should be in compliance with Green Book and COSO. Keyword there is should be. It's not a must requirement, but many organizations are referring to Green Book and COSO as a best practice tool as they set up the framework for their internal controls. Okay, subrecipient monitoring. This is another area with significant changes. So really three, I guess, main key changes or areas of focus here. One is with respect to, there's clarified guidance now on the responsibilities of the pass-through entity and the subrecipient. So the guidance states and clarifies that there's certain information that the pass-through entity must include in their subaward, including the indirect cost rate, the CFDA number, the DUNS number, the federal program name, and other pertinent information. So these are elements that you must have in your subaward between your pass-through entity and the subrecipient. The other big key emphasis and change here is that pass-through entities must evaluate each subrecipient's risk of non-compliance. And the purpose of performing the risk assessment is so that pass-through entities can determine the appropriate level of subrecipient monitoring. So keep in mind there's two parts of this. There's the risk evaluation piece and there's a subrecipient monitoring piece. And the purpose of performing the risk evaluation is so you can determine the extent of your subrecipient monitoring.
So what does that mean, evaluating risk of non-compliance, and then how do you do that?
Yeah, so it's a good question, and really what that means is that as a pass-through entity, you need to understand your subrecipient. You need to understand what's their risk of being able to comply or not comply with their federal award. So look at their experience with subawards in the past. Are they a first-time recipient of a subaward, which will likely make them a higher risk subrecipient? Or have they had awards in the past and are very familiar with the terms and conditions of these awards? Look at the results of past audits, pull up their audit reports, and see what the results of those past audits have been. Have there been any changes to personnel or systems? Have there been turnover? Have they implemented systems implementations? All those factors would be indicators that they would be of a higher risk subrecipient. Let me see what else. There's look at the results of any external monitoring by federal funding agencies. Many times the federal funding agency will come out and perform their audits. And if they do that, look at the results of what those audits have been. All of these things could be considered as part of your risk evaluation process. And then once you perform the risk evaluation process, then you perform the subrecipient monitoring procedures. And the new guidance clarifies the procedures that have to be performed here. One is that you have to review the financial and performance reports, and you have to determine if they've been accurately and timely completed and filed, and also following up to ensure that your subrecipients are taking appropriate action on any findings. So moving to the next slide, implementation tips. I talked about some of this in the previous slide, but read through the subaward agreements. As a pass-through entity and a subrecipient, read through your agreements and make sure that it includes the required elements, and if it doesn't, work with the respective parties to get those elements included in the report or in the award document. And then one of the objectives of the risk assessment is so that pass-through entities are operating with a more risk-based and smarter approach. So tailor the extent of your subrecipient monitoring procedures to the results of your risk assessment. So based on your risk evaluation, you deem the subrecipient to be a low-risk subrecipient, reduce the procedures there and spend more time on other subrecipients that you may deem to be of higher risk. And then document all this. Again, the guidance doesn't state that this has to be done, but we strongly encourage you to document the risk evaluation piece of it and also the subrecipient monitoring piece of it. And we have certain risk assessment matrices that we can provide that will help organizations perform this process. But the key here is to do it as a pass-through entity. You're responsible for the spending of your subrecipient. So be involved in their work, understand the work that they do, perform site visits. This works really well that I've seen my clients do. And again, make sure all of this is documented so there's a trail that it was done. Okay. The next area that the new guidance really focuses on is compensation and payroll costs, which makes sense because many federal awards, this is one of the largest components of costs in federal awards. So the core changes here are really meant to reduce some of the administrative burden surrounding reporting payroll costs, but at the same time beefing up the controls and the overall accuracy of payroll reporting. And the key concept here is that payroll costs need to be supported by records that accurately reflect the work performed. So for all payroll costs charged through to an award, you must have documentation and a trail support that clearly indicates who performed what, how much time they spent on it, and that it's incurred in accordance with the objective of the award. This is especially important for organizations that have employees that work on multiple awards or both federal and non-federal activities. It's important to have an allocation of their time between these activities. How this differs from the new guidance, or the previous guidance rather, is that the previous guidance was very strict in terms of documentation. It stipulated that certain records had to be maintained, only certain individuals could approve those reports. Those reports had to be submitted on a periodic basis. The new guidance is less steadfast on these requirements, but it has a higher emphasis on having sound internal controls over the payroll process. And one thing that's new in the guidance is that organizations must have a written company-wide policy with respect to their payroll practices, and your compensation with respect to your federal awards has to conform to that written policy of the organization.
So what's the best way for organizations to document and account for payroll costs that need to be charged to a federal award?
You know, I still think the best way is through timesheets and time cards. That's a tried and true way to document your payroll costs. The new guidance doesn't require you to maintain timesheets, but if you already have a timesheet system in place and it works for you, I wouldn't recommend changing it. At the end of the day, that still is the best way to have effective oversight and controls and documentation of what employees are doing. With respect to implementation tips, I'm telling a lot of my clients now that make sure you've established and you maintain written policy for your compensation practices, and make sure that your payroll that's being charged through to your federal award conforms to the written policy of your organization. So those were some of the real high level overview of some of the key changes and what organizations should be doing now from a preparation standpoint. A few other areas as you prepare is the schedule of expenditures of federal awards. This is an important schedule. It's a key schedule that we use to start the single audit. So ensure that you have an accurate CFA. Make sure it reconciles to the general ledger. If it doesn't, be prepared to explain any variances. This is a key schedule. Many times it's a schedule that would lead to a delay in completing the single audit on time. Work with your auditors in advance to make a sample selection. Many of our tests are conducive to making sample selections in advance. So work with your auditors, get that out a week or two before we start field work, and also gives you an opportunity to identify any missing documentation so you can go back and pull that support. Many times as part of our audit, we also have to go on site to perform meetings with the program managers, review participant files or program files. So schedule that in advance. We've encountered some issues in the past where that's been scheduled later in the process, and the program managers or site managers may not be available. So determine whether or not that site visit is needed, and if so, plan that in advance. Educate and train, big area this year, especially this year. This is probably in over 20 years the biggest, most changes that the grants community has seen with respect to federal funding. So now is really important time to train all your staff involved, make sure they understand the new changes and how it impacts your organization. Use your accountants or auditors as a sounding board, as a resource. We're more than happy to help you navigate through these changes.
So Grant, if I'm going through my first single audit, or I've had turnover in a position that kind of runs my federal awards, what should I be doing right now?
Well, if this is your first time going through a single audit, hopefully we've had that discussion with your auditors early on through the year. I've had many certain situations where organizations haven't maintained a good communication. We find out that they had they've been operating under a federal award when it's too late in the process, and they weren't maybe aware of all of the bureaucratic red tape and requirements, and that gets them in a little bit of trouble. So if this is your first time going through a single audit, have the communication early on with your auditors. If you had turnover in key positions, work with your auditors. We have resources here that we can assist you with in terms of getting ready for your single audit preparation. But the key is just have open communication with your auditors, and we're here to help you. And we want to see you have a successful single audit.
So what are some resources that organizations can refer to in order to learn more about these changes or prepare for their single audit?
Check the COFAR website. The COFAR is a group that's been tasked with overseeing the single audit changes. Check the Code of Federal Regulations itself. Check the AICPA website. They have a lot of good information. We have several archived webinars on our website that provides good information. We have an upcoming symposium on July 15th, I believe, and one of the sessions would be going through these changes with a more in-depth discussion. So a lot of resources out there. We have about 7 or so minutes left. I want to keep some time for some questions at the end, so I'll try to wrap up this piece of discussion rather quickly. Single audit changes. This is a third area of change. The big change here is that there's been an increase in the threshold from $500,000 to $750,000. Again, this will be effective for December 31st, 2015 year ends and June 30th, 2016 year ends. So if you have an upcoming June 30, 2015 audit, your threshold will still be under the $500,000 threshold. One thing I want to say here, though, is that for organizations that have a spending budget near $750,000, you may want to take that into consideration as you're budgeting, because that may put you over the threshold that will kick in the single audit. So one way to get around having the single audit is to manage your budget and keep it under 750 if you're right at that threshold. And so again, that was just a high-level overview of the changes to the federal grant administration process, and hopefully that was helpful for you to start thinking about now as you plan for your upcoming single audit.
Great. Well, thank you, Grant and Dean and Monica. We have had a couple of questions come in, and I believe these are all directed for you, Grant. Oh. So I'll read them off for you here. First, if a county historical grant is awarded for a specific renovation purpose and paid as a reimbursement, is that considered an exchange transaction? No goods or services were provided to the county.
If I'm understanding the question correctly, this is federal funds that were received under the award, and they were used to build. I can't see the question here.
It actually says it's a county grant, not a federal
grant. Mm-hmm. Typically, county grants, again, you would have to work with the county agency to understand what their intent of the award is. Many times you'll see county grants to acquire capital equipment. That equipment has to be returned back to the county at the end of the award. But generally, county grants and grants and contracts with government agencies are accounted for as an exchange transaction. But again, this situation would have to read through the terms and condition of the award, understand the facts and circumstances, and we can make a better determination.
Okay, great. Thank you. Another question asks, for risk evaluation of subrecipients, is review of their A133 audits sufficient, along with the observation and tracking of their activities?
That's part of the process. There isn't a specific checklist that things that you must do, but evaluating their A133 report is probably one of the more effective ways and more efficient ways of performing that risk evaluation. I think certainly talking to the organization is probably the best way of performing that risk evaluation. Is just just understand them. You're working with them, speak with them, understand what their experience is with federal awards, but certainly reviewing their previous A133 reports is probably the most is the most effective and efficient way of performing that risk evaluation.
Okay, great. Another question, it says, are state grants that pass through federal monies Our state grants that pass through federal monies to our organization do not provide an indirect rate to our organization. The state agency states they do not have to pass through their indirect rate. Is that correct?
This is one of the key areas of change, and it's frustrating because one of the key areas of change of this the OMB has issued is that all organizations that have a federal award are allowed a 10% de minimis rate, or if you have a federally negotiated rate, then you can elect for a one-time 4-year extension of that rate. So if you are a subrecipient, it sounds like you're receiving money from the state and the state is passing it through from a federal agency, you should have two options here. One is you should be able to elect a de minimis 10% rate, or if you already have a federally negotiated rate, you should be able to elect an extension of that rate for up to 4 years. I'm seeing certain situations like this where the state agency isn't following all of the requirements of OMB, and this is an issue that the grants community is aware of, and it's still being resolved. But that's one of the key changes is that organizations are allowed the use of an indirect cost rate so they can recoup all of their costs of operating the federal award.
Okay, we're going to do one more. We've had several questions come in, so I will ask Grant and Monica and Dean to review the extra questions that we've gotten and reply by email. So I want everyone to know that you will get a response, but we'll just ask one more here. We get grants that are paid upfront, but are basically cost reimbursement contracts. We have to return the funds if not expended completely. Are those restricted?
So if it's under a exchange transaction, that would just be recognized as deferred revenue. So it sounds like you have a contract with the government agency. They've advanced funds to you. You would recognize the revenue as you incur the expense. Any expenses that aren't incurred, so the portion that you've received less the expenses you've incurred, that will be recognized as a deferred revenue and will be returned if you don't use it. Right.
Great. Okay. Thank you all for this great information. And as a reminder, Grant did mention Armanino is hosting a nonprofit forum on July 16th in San Francisco. I'm sorry, it's July 15th.
It might be 16th. I'll get the date straight. Send it out.
That will be in your follow-up email that you receive from us. We'll have a link to that event. But a lot of this information will be expanded upon at that event. So we look forward to seeing you there, and thank you for joining the webinar.